There's something called a technical recession and there's something called an actual recession. A technical recession, for all general purposes, is 2 negative quarters of GDP. That is a technical recession, and that is actually what a recession is. But then you have the actual recession. I know it sounds confusing. The actual recession is a board of members that actually declares, yes, we are in a recession, and they look at more than just negative GDP growth. It's done by a non-for-profit called the National Bureau of Economic Research. And they're gonna give us these numbers later on, after the fact. But if our GDP numbers come out at the end of this month that we're negative 2-point-something%, like the Atlanta Fed is forecasting, that means that we had negative 1.6 last quarter, negative 2.0 this quarter or so, which means that we are in a technical recession. The question is, how long does this recession last, and why is this recession a little different? This recession is a little different because of our unemployment. We have near record low unemployment. And usually when you have a recession, you actually have higher unemployment. That's why Jerome Powell keeps saying if we have a strong labor market, we can keep raising interest rates. And if we raise interest rates, this is going to lower inflation in the long run. This is a game of cat and mouse. Why is the jobs market so strong? The jobs market is so strong because it's a product of what happened in COVID. Because of COVID, there was a lot of people that started working from home. Because you started working at home, you did not want to go back to the workforce. Because you didn't want to go back to the workforce, a lot of jobs opened up. That, in addition to this crazy unemployment that people made money, they didn't want to go back to work. And the people that did go back to work wanted more money. Because the people that went back to work wanted more money, employers were forced to pay this money. Because employers were forced to pay this money, a lot of employers cannot just lower the threshold, which means that they're still paying out these crazy, crazy prices. So slowly but surely, people started going back to work. But there's still a limited amount of people that went back to work because some people just said, hey, we're not doing it. We collected enough money in unemployment. We changed our profession. We went back to living in our mom's basement. I don't know. Of course, I'm oversimplifying this, but I'm giving you a general macro understanding of what's happening. But it doesn't mean that there has not been recessions in the past where unemployment was relatively stable, where unemployment was relatively strong. This is from Wikipedia. I'm making my life really, really easy. There has been as many as 48 recessions in the United States. These 48 recessions go back since the beginning of time of the United States. But we're going to be looking a little bit newer. This is called the modern age of the United States. The National Bureau of Economic Research dates recessions on a monthly basis back to 1854. According to their chronology, from 1854 to 1919, there were 16 cycles. The average recession lasted 22 months. We don't really care about that because that's old school. A little bit modern age, 1919 to 1945, there were 6 cycle recessions, lasted an average of 18 months. Again, that is a little bit better, but we want a little bit more of a modern age. From 1945 to 2001, there was 10 cycles, and these recessions lasted an average of 10 months, and the expansion on average of 57 months. This has prompted some economics to declare that the business cycle has become less severe. The reason why it becomes less severe, all of these recessions, and why I don't think we're ever going to get another Great Depression, is exactly what happened during COVID. The government will bail us out and they will not let us fall. Yes, we're now dealing with a recession after what happened during COVID. But if they would have never bailed us out, then we would have had a Great Depression like we've never seen ever. So yes, this is a ends to the means that were done during COVID. So this is our current modern recession plan. And again, because of technology, because of the government, because of intervention, all of these things definitely make a difference. And all of these things play on how severe and how long all of these recessions are going to be. Many factors that have contributed to this modernization included the establishment of deposit insurances in the form of Federal Deposit Insurance Corporation in 1933. That's that FDIC insurance that people love so much. And that basically means not what you think it means. So you think if you're going to go to the bank is going to guarantee your funds. I think it's $250,000 right now. And you can get over $1 million if you want to play the game, if you do it between businesses, between personal, kids, married, joint, so on and so forth. It doesn't mean you're going to go into the bank and you're just going to get your deposit. That's not what it means. It means that if a bank goes under, the next bank that takes them, their bailout must guarantee your funds. They can't just bail that bank out and say, deuces on your funds. That's what it means. How long your funds will be available in, nobody says. So it could take a day, it could take a year, it could take 10 years, but your funds are safe and insured. Because most people understand that their funds are insured and don't understand how they're actually insured, this causes something called the null and void of a bank run, which means you're not going to run into the bank, all of us at once, and take our money out. The banks use something called a fractional banking reserve, which means that they don't have a one-to-one dollar to your money. They probably keep 10% or less value of your actual money. And then it says, since the early 1980s, the sources of the Great Moderation has been attributed to numerous causes, including public policy, industrial practices, technology, and even good luck. As I said, technology is going to change a lot of things. If you guys know on this channel, I do love Palantir very, very much. I also love companies like NVIDIA. I also like companies like Tesla. And if you think about it, what do these companies do? They solve problems. They're going to reduce inflation in the future. They're going to increase production in the future by solving issues. That's what I personally believe, and that's why I'm invested in these companies. But anyways, these are the actual recessions. You have the Great Depression, which lasted 3 years and 7 months, negative GDP 26%, unemployment was 21%. 1937, there was a recession. It lasted 1 year, 1 month. Unemployment was between 17.8 and 19%. GDP went down 18%. Recession of 1945, it lasted only 8 months. That recession, GDP went down negative 12.7%, but unemployment was only 5.2%. See, this is very similar to what I think we're going to be having in this country, if you think about it. GDP went from, I believe, positive 6.9%, then negative 1.5%, and right now it's going to be like negative 2%. If you think about it, that's around a negative 10% or so of GDP, top to bottom, without knowing what's going to happen in the next quarter. So it's going to be very interesting to see. 1949, it only lasted 11 months. GDP only went down 1.7%. Unemployment 7.9%. Recession of 1953 only lasted 10 months. 6.1% unemployment. GDP only went down 2.7%. Recessions of 1958, 8 months. GDP only went down 3.7%. Unemployment was 7.5%. Recession of 1960s, unemployment was 7.1%. Negative GDP of 1.6%. Lasted 10 months. Recession of 69 lasted 11 months. Negative GDP only 0.6%. Barely a recession. Unemployment was 6.1%. 1973, we had 1 year and 4 months, and we had a negative GDP 3.2%. Unemployment was 9%. 1980s, we had a recession, and 1981, we had a recession. Those lasted 6 months and 1 year and 4 months, respectively. GDP went down 2.2% and 2.7%, which means that we probably had a recession, we recovered, and we had a recession right again. Now, early 90s, 8 months, negative 1.4 GDP. Early 2000s recession, 8 months, negative 0.03 GDP. And then you had the Great Recession, which was the economic meltdown where the banks got bailed out, and why we actually have Bitcoin today. This lasted for 1 year and 6 months. Now our GDP went down 5.1%, and our unemployment was double digits at 10%. COVID recession, it only lasted 2 months, and the reason why this didn't become a Great Depression is because the government stepped in and bailed us out. As much as you think they did the right thing or you think they did the wrong thing, I think they went a little too aggressive, but the situation that we're in now is a lot better than the situation that could have been during COVID. Negative 19% GDP. This lasted 2 months and our unemployment was nearly 15%. The government needed to step in. The government needed to do what they're going to do. Guys, if you look at these charts right here, you can see that the average recession, as they said, is 10 months. Currently, our recession has lasted for 6 months, 2 negative quarters. If you think about it, we have another 4 months of this recession. Again, this is an average. It could go more, it could go less. I think that we have another 4 to 10 months of what's happening, and then this economy is going to turn around, and I think we're going to be in the green for the economy. Let's say at the end of this year is going to be the worst part. Then we start recovering. All you need to do is to be able to survive this year. And if the worst part is going to be over at the end of this year, you have to prepare for the bull run in the bear market. After quarter two earnings, which is going to come out at the end of this month and in the beginning of next month, I'm going to be looking to get back into a lot of positions when it comes in the stock market. I am buying every single day. For my public stock portfolio, I put in around $50 every single day. On top of my initial $10,000 investment, I put in another $5,000 investment, and I share my public portfolio with the Patreon group, with the Telegram group. Shout out to the Wolfpack. I love you guys, and thank you so much for giving me all of the support. Guys, you cannot time the market. You can't time the market. I'm going to tell you something. There was a video the other day about Chicken Genius. Guy is very, very cool. He made a chart. There's 4 quadrants. And he was explaining that this current quadrant is time to sell and have money on the side, and then you're going to rebuy later when there's going to be a bull run. The problem is when you sell out of your shares, and I'm not saying to sell, I'm not saying not to sell, but the problem is when you sell out, psychologically, it is extremely difficult, nearly impossible to be able to time the market when the market is going to recover. The best you can do is exactly what we're doing on this channel. You try to make educated guesses. You try to have a hypothesis. You try to have a thesis. You try to back it up with historical data. But what happened in history doesn't necessarily mean it's happening today, and definitely doesn't mean it's going to be the driving force for what's happening tomorrow. Because, as I said before, and as they said before, there's a lot of technology that's coming out daily that changes things left and right. Tomorrow, there could be a technology that's going to come out and change everything, and inflation is just going to go down, down, baby. And then what's going to happen? Everything's going to bull run. Stock market was in a recession. Stock market was in a bear market. And if you look at the NASDAQ, there was even an entire market collapse. How does it work? 10% is considered a correction. 20% is considered a bear market, while 30 or more percent is considered a complete market collapse. NASDAQ, we had that. S&P and I believe Dow Jones hit the 20% and we were teeter-tottering. Now, a lot of people are going to tell you, Adam, listen to me. The average recession lasts for this long. The average bear market lasts for this long. And in that average bear market, the S&P can go down 35%, but we only had around 22%. Yes, that's true. But as I'm going to tell you again, that's the average. And what happened in the past doesn't necessarily dictate what's happening today, and definitely does not drive us into tomorrow. All you can do is have the data and make up your own mind. Yes, the stock market can still go down to 35% negative. It could, or it could not. And it's very, very hard to time the market. So for everybody right now that's waiting to invest or is invested or doesn't know what they're doing, guys, just do your own research. And the best possible method that you can do is DCA daily. If you're buying every single day, you're going to get the average best possible price, which is what I'm currently doing in my public stock portfolio and what I'm doing in one of my smaller portfolios. I do have some money set aside that I told you I was going to wait until quarter 2 results to put money in. And if I can't time the bottom, that's okay, because all I need to do is time the bottom-ish, because eventually the markets are going to recover. The most money that you've ever made is not going to be during a bull market. The most money that you make is preparing for a bull market during a current bear market. Now that I gave you all the data, you guys got to make up your own minds. But I urge you, don't just listen to me. Don't listen to these gurus. Don't listen to these geniuses. Do your own research, right? This channel is a guide for you guys. It's just giving you a lot of data. It's giving you a lot of knowledge. But at the end of the day, it's what you do with this data. It's what you do with this knowledge. I'm like a librarian. I just gave you a book. It's your job to open up the book and actually read through the pages and try to come to your own conclusion. Guys, if you like this type of data, if you like this type of theoretical thinking, please subscribe to my channel. And in the comments down below, let me know that you subscribe. And in return, to say thank you for you guys subscribing, I'm going to give you a comment myself and say thank you in the comment section down below. Have a great day.